Thanks everybody for waiting. You can see there was quite a few people there. So thanks for following me on Twitter. You'll always get the announcement ahead of time when that happens. So follow me on Twitter. There it is. There's my handle. Facebook as well. You can search me out there and you can friend me on Facebook. I will accept it. I can see the comments. It's that one comment from Vanessa there. Happy Chinese New Year. She's playing mahjong and winning a little bit of money, so good to see. I'll just wait for a few more people to roll in, and then we will get started. Yep, got the coffee ready. Wow, that's too hot. I zapped it really hard, or really high, because I don't know how long these things are going to go. In the past, we've gone a couple hours. One of them was 3.5 hours. So I got the coffee as steaming hot as I could make it, and I pretty nearly there burned my mouth. So, but anyway, about that timing, I'm going to try to keep things about an hour, maybe an hour and 15. I really have to be better on the time management. I definitely appreciate people who stay for the whole thing. We've done a 3-hour live stream, and there was plenty of people staying for the whole thing. So I definitely appreciate that. But at the same time, I do always say this, but it would be better if I just did them shorter and then did more of them, at least one per week, maybe twice per week if they were limited to just an hour. I think that would be better. And I think more people would be able to tune in, find an hour here and there. 3 hours is asking a lot. So I'll do my best. We'll try again today. We'll see how long this thing goes. I'm just going to play the intro while we're waiting for a few more people to show up to make their coffees, and then we will get started right away. So thanks everybody for joining in. Really do appreciate it. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. All right, so thank you very much for listening to that. I do see some comments coming in already. What I'm going to do is I'm going to try to stick to the standard format where I'm going to do a little bit of presentation just on a topic that I choose for the week. And then I'll try to keep it short, I promise. And then we will get into some questions. So you can either ask me questions directly based on what I just presented, or if you've just got random questions, that's fine too. I can see in the chat, there's already talk of Uvxy. Of course, it's the big one in the volatility space lately. A lot of interest in that one. There's a UFC comment already, so I'll circle back and I'll answer the comments. But what I essentially wanted to talk about today is the fact that there has been a volatility regime shift, right? Depending on how long you've been trading volatility for, you may have noticed that it's been a little bit tougher in the last few years to find those profitable trades. And certainly if you've been trading for, say, 8 or 9 years, I've been doing this for over 10 years and since the VXX launched back in 2009. And there's no question that you have to have a little bit more understanding of the market these days. You have to be able to structure your trades very well. You have to be able to manage risk very well. The old, let's just short volatility, blindly and just make a bunch of money. that does seem to be going away or gone. I don't know if it ever really existed. There was always risk out there. But certainly these days, you really have to understand the market. So what I wanted to do is quantify what the volatility regime change actually looks like from my perspective, right? Anybody can come on here and they can say, well, things are different now. And, people who trade stocks or whatever they trade, sometimes they'll just try to make a case. They'll say, well, it's different now. That's why things are behaving a certain way. I like to actually quantify numbers. So the first thing that I want to get into is everything I'm going to be talking about today is from the perspective of 2011 to February 5th, 2018, and then from February 5th, 2018 through until current, right? So the last 3 years versus the previous, say, 6 years. And I'm sure most people who are following my streams, volatility specific streams, you understand why I said February 5th, but just for the few of you who don't understand that, February 5th, 2018 was a very memorable day for all of us in the sense that, let me get the screen share going here, in the sense that we actually did see what is the largest volatility spike in the last 30 years. So this is the 25 largest daily percent change Vix spikes since 1990. That's when we have Vix data going back for. And you can see it right there, February 5th, 2018, 115.6% spike in one single day. Now the S&P was down 4% that day, but the VIX index specifically and volatility really went berserk that day, and we spiked 115%. Pretty amazing stuff. Now, that's probably not the largest volatility spike ever, because as I did a video recently, if we just drag it back 3 years using the old VXO calculation, which uses the S&P 100 instead of the VIX using the S&P 500, we can see that in October 1987, we would have seen something significantly worse, of course. It could have spiked as much as 313%, and that's close to close. It was about 375% intraday. So for anybody out there, just this is a quick tangent, the VIX calculation doesn't actually top out at 100, right? That's just a number that people think is some type of ceiling, but of course the VIX can go much higher than that. Doesn't make much practical sense to go over 100, but the number itself can certainly go over 100. Now, what did that do to the volatility markets? Well, as we know, that was the day that we lost one of our favorite volatility products. It was called the XIV. Now, the XIV was a 1x inverse volatility product that is essentially a short volatility position. So if you were to buy this thing, you are holding on the long side a short volatility position. Now, this product was actually very popular because of that aspect, that instead of doing the standard things like finding available shares and shorting those directly, or using options and selling premium, things get a little bit complicated. Of course, just buying the XIV was also a short volatility position. Now, unfortunately, on that day, on February 5th, 2018, we lost this product. The XIV, you can see it down here, it lost 96% of its value in a single day and was terminated. Now, again, just for little side tangents here as I'm talking, if you are curious, the XIV didn't actually gap that day, and it wasn't terrible right from the start. You can see that the market was actually pretty calm early on. What ended up happening, it was down about 30%, I think 33, something around there, during regular hours, but the aftermarket 15-minute rebalancing is really what did the kill shot. So it's a little bit deceiving to say that a product crashed 96% in a single day. That's not actually what happened. There was basically a liquidity crunch in the VIX futures market where they have to do an aftermarket rebalancing. And because the volatility products themselves, all of your UVXYs and TVIXs and all the products like that, they have to do the same rebalancing in the same time period. That actually caused the futures prices to just go insanely high. And these aren't products that are actively managed where the managers can just say, we'll wait a day or two and we'll go ahead and, we'll pass on doing our rebalancing now because the futures are doing what they're doing. They have a methodology and they have to get into that market, like it or not. And that's what ended up happening. So the XIV was what most people attribute to the February 5th event. Now, personally, I wasn't holding the XIV. I didn't suffer any losses during the Volpocalypse, as we call it. But there are some lasting effects, and that's what I wanted to talk about today, is that we're not actually talking about something that it happened on that day. And if you happen to escape it, if you happen to move to cash at the right time, then good for you. It won't have any future effect. That day was actually fairly specific, and it launched what I call a new volatility regime where everything has just been bumped a little bit higher. And that's what I'm going to show now. So the first way that I'm going to do this is with what I call my Vts Volatility Barometer. Now, it's my own volatility index. I don't share the methodology, so it's not something that people can recreate themselves. So after I show my volatility barometer, what I'm going to do is go ahead and show something that people can calculate through the VIX futures and show the VIX or the volatility regime in that sense as well. But my volatility barometer is self-calculated based on a whole bunch of metrics that I track every day. And it's basically, you can look at it as a pure number, as a percentile ranking, or you can look at it in a chart. And we can actually see since launch, this chart looks a little bit messy, but this is the volatility barometer since I launched it in January 2011. That's as far back as I can go because some of the metrics inside this barometer, they actually haven't existed for very long. So that's unfortunately as far back as I can drag it. I would love to take it to 1990s or whatever, but VIX futures launched in 2004. Some of the other indicators launched later than that. So this is the earliest that the signals actually become robust enough to use. But you can see what's happening here. So my metric, unlike the VIX, mine does go from 0 to 100. Let me just double check if I'm screen sharing. I make that mistake all the time. So my metric does go from 0 to 100%. You can see it oscillates around as volatility is going up and down. High readings are high volatility and low readings are during the lowest volatility periods. So you can see, 2017 was basically a cluster of the lowest volatility we've seen. Now, this green section is everything before February 5th, 2018. And my volatility barometer averaged 40.62% during that time. So actually about 10% below that 50% level. And then since February 5th, this is the volatility regime change. Very, very clear change there. After February 5th, where now we're averaging nearly 60%, a full 10% higher than the 50% number and 20% higher than the previous average. So it's not that difficult to understand how this could potentially affect our trading. If you had that impression that you could just go long the market or just short volatility and you could go ahead and get those profitable trades and it was fairly easy, clearly this period over here, that's going to be a much more difficult trade to manage. It's going to be much riskier. There's going to be more whipsaw action. And just in general, to have higher volatility levels, we don't see those periods where it drags into the 20s and the 30s very often. And that, of course, is going to be affecting people's trading. Now, just as an example of how it could potentially affect my trading, I do have one strategy. We call it the VB threshold strategy. And what this is using the volatility barometer, dividing it up into 20% sections. I have a better picture here. Dividing it into 20% sections and then holding a certain ETF that performs best historically in that range. So you can see from 0 to 20, we're holding TLT. Of course, equities and short vol, they really don't perform very well when volatility gets extremely low. That's kind of when the market might be running out of steam, might be on its last fumes there and ready to sort of bounce higher. So we just hold treasuries there. But this 20 to 40 for SVXY, which is a short volatility position, and the 40 to 60, the S&P 500, that's sort of the kill zone there where the best profit is probably going to come from those two sections. And of course, if we're seeing those very common sections for 6 years straight, then it's no surprise that that strategy was killing it for those periods. It's not doing bad now. It's still performing reasonably well, but it's not difficult to see why we had such high concentration of aggressive positions. Nowadays, we're over 60% quite regularly, and that's when we get into the treasuries, the safety positions, where we're still making a little money, but it's basically profiting a safety position. Then if we go over 80, we can actually go long volatility. But you can see here, this volatility regime change, of course, it does affect me, but it also affects everybody. Even if you're not a member of our community, it affects the types of trading that you can do as well. It will affect what you are going to be successful with. Because again, We're not getting those long, prolonged periods where volatility is extremely low and the market is just on a low volatility climb higher. We're seeing far less of those, at least in the last 3 years. So now what I want to do, because of course the volatility barometer, I don't share the data. It is proprietary. Sorry about that. But I do want to share something that all of you could, if you wanted, calculate. It's not completely simple, but I have actually explained it in the past. So that is called, for our purposes, here's my spreadsheet. It's called the VX30 to Vixx roll yield. Now, what this metric is showing, it's basically a calculation where I'm calculating something called the VX30, and then I'm comparing that to the VIX index. And the relationship between those two things is very instrumental in how these volatility products can potentially move around. Of course, there's nothing written in stone. Just because this number is high doesn't mean the market couldn't crash tomorrow, but that's essentially what this metric is showing. So this is the VIX futures term structure. We're all very familiar with this. This is VIXCentral.com, all of our favorite website. These front 2-month products are what the volatility ETPs are tracking, most of them. There are midterm futures contracts as well, but it's basically these front 2 months. So what my VX30 is, that VX30 portion of this metric, is just a 1-month constant maturity future of the front 2 months, because that's the methodology that the volatility ETPs use. They don't use the front month, they don't use the second month, they use what's actually a rolling 1-month contract. So it's a pretty simple calculation to get the VX30, and then we're just comparing that to this green line here, which is the VIX index itself. Now, if the roll yield is positive, it means the VX30 is above the VIX, and there is potential, again, just potential, for those futures to continue to drift lower towards the VIX index. That might be a tailwind for short volatility. If the VX30 is down here below this green VIX index, that, again, careful with my words, but that might be a headwind for the short volatility trade. So that's what this VX30 is showing here. It's basically showing the potential for where these products are going to be moving around. Now, right now it says 20.69. That's a very high number. The higher, the better. Essentially, for the short vol trade, the higher number, the better. We're in the 94th percentile ranking. If we look at the long-term chart, looks like this. We've got the green line, which is the long-term median, about 8%, and it oscillates around. It can go negative when there's major events. Of course, this deep one here, this is the financial crisis. This is the European debt crisis. This is the China hard landing scare. Volpocalypse right there, Q4 2018, and then, of course, COVID. So it can go pretty low, but most of the time there is positive roll yield, and most of the time, at least about 75% of the time, there is a tailwind for the short vol trade. So if we go look at just a 1-year chart here, you can see we are substantially lower in the last 1 year than the long-term median. But again, showing that volatility regime change on a metric that you could calculate yourself, if you wanted to calculate that, by the way, go to my website. This is the front page of the website. Under this one called Dashboard, I actually have articles and videos on all of the individual metrics. And you can go to the one that just says VX30 to VIX roll yield. And in this article, I first of all explain what it is, basically the concept I just went over. And then I actually show how you could open up an Excel spreadsheet and do all your calculations. You can get the math right there, and then you can have your metric of your own. So that's how a person would go about calculating it. But essentially, you can see the same thing here. January 1st, 2011 to February 5th, 2018, roll yield was 10% during that period. And yes, we did have some negative. There were some times when people who had the idea that you could just short volatility blindly, of course, they got destroyed. There were plenty of periods where people got hurt. But in general, it spent 10%, or most of the time, at a 10% positive roll yield. But in the last 3 years, clear as day, it's basically half of what it used to be. We are averaging 5.47. And again, you got to remember that that includes 2019, which was a pretty good year for the stock market. So in this 3-year period, there is a lot of whipsaw built into that. And this right here, again, is what I'm calling my volatility regime change. You can see it here with my own private volatility index. And then, of course, the VX30 to VIX roll yield. You can see it as well right there. So there's no question that mathematically we can quantify that things are different right now. It's not just a feeling that we have. It's not just us noticing, oh, wow, there's been some volatility spikes recently. I mean, 2 weeks ago, where's that one there? Just 2 weeks ago, we actually saw the third largest spike in history. Where's my numbers? This one. Spiked 61.64% just 2 weeks ago. So we are seeing some occurrences here where we're getting faster volatility scares. And if you kind of scroll down this list here, you can see several of them are from 2018 and later. So we are in a volatility regime change. Now, how you respond to that, of course, that's up to you. I know my plan of attack. I'm very quant-based. I'm systematic with my investing. But if I could give you just some general, very quick, back of the napkin tips to handle this volatility regime, the first thing, of course, would be, and this always applied, even back in the good old days when shorting vol, I was making 50% a year doing it, the good old days. Even back then, you want to keep your position sizing small. So it doesn't matter how successful you are at your volatility trading, you still only have to have that a smaller portion of your portfolio. I cannot tell you how many emails I got because I've been managing my business for over 9 years now, and my volatility strategies were making over 50% a year for 7 straight years. I can't tell you how many emails I got from people telling me, well, why don't you just allocate all your money to that? Clearly that's working. Why don't you just put 100% of your capital in that? The same thing applies today as it did back then. It doesn't matter how good you are at this. Most people are much worse than they think they are. I don't mean to be too blunt, but most people have very short-term success and they're extrapolating that into, oh, well, if I just do this for another 10 years, I'm going to be a millionaire. What they don't realize is that volatility does bite back against all of us. Even the best strategies will get killed once in a while. But it doesn't matter how good you are. Even if you are 1 in 100 that you are really good at this, still keep those position sizes small. The second thing applies to everything. I'm not, reinventing the wheel here, but diversify. You want to make sure that the rest of your portfolio isn't also in risky things that are directly correlated to your short vol trades, because then you're just allocating more capital to essentially the same thing. So that's why for the VTS community, for example, we do have several strategies that, these trade stocks, bonds, gold. We've got, of course, this one rotates around. This one can take utilities positions, treasuries on the low end. And then, of course, I've got the whole options community as well, which is 20% of the portfolio. So the direct volatility strategies, they are significant enough that if we go on a nice run, and I suspect I will have plenty of periods in the future where it's working out extremely well and I'm very happy, it's a significant enough portion of my portfolio that I'm going to feel those gains and I'm going to appreciate that my strategy's working. But it's not a big enough position size that it can completely take me down if it doesn't happen to go well, because sometimes the market just doesn't cooperate with your plan. We all have a plan. We all think this is going to work. This is how it's going to play out and I'm going to make this money. The market has a funny way of interfering with our plans. So that would be the second thing. And the third thing, I think I've said this in every stream, and I hope that I find an opportunity to say it in every single stream for the rest of my life, is no undefined risk positions. Don't short the volatility ETPs directly. That is just asking for trouble. Shorting stocks, shorting ETFs, those are unlimited risk trades. And please, regardless of who you follow on Twitter or what you see on social media, do not sell undefined risk options on volatility ETPs. Don't be going out there selling Uvxy calls. Don't be selling VXX calls. Don't sell straddles, unprotected straddles, strangles. Don't be doing those types of things. Obviously, I'm not registered to give you direct personalized advice, but please do yourself a favor and understand that as good as you think you are at this and as much profit as you might have made in the last year, that doesn't extrapolate out to the next 10 years. We have no idea what's on the horizon. None of us do. We don't know if we're getting another October 1987 375% Vixx spike. We don't know. I suspect maybe not, but, always define your risk, always diversify, always keep your position sizing small, and make sure that your volatility, smaller percentage of your portfolio, is not too highly correlated with the rest of the things you're doing. And if you do those things, then short vol is amazing. I think oftentimes I get emails from people saying, when they hear me speak and they hear me on streams and they read my articles and videos, they might get the impression that I'm actually not a big fan of shorting volatility, which what I would say is, I've been doing this as long as anybody. I mean, if you can find somebody who has nearly 1,000 articles and videos on shorting volatility like I do, has been doing this for so many years with a proven track record, clearly I like shorting volatility. But I just do it from a position of always protect capital first. First and foremost, don't do anything stupid. After that, we can find plenty of opportunities to make some money. But you certainly don't have to do stupid, risky things in order to make a good rate of return. So don't think that I'm saying, that don't bother. It's a different volatility regime. We're not going to make any more money anymore. Things are different these days. It's not that at all. I'm just quantifying the fact that things are harder now. You need more knowledge. The barrier to entry of being a successful volatility trader is higher now than it's ever been. So just understand that if anything that I showed you today, if the VX30 to the VIX roll yield is new to you, if those VIX futures surprised you, if you don't understand the relationship between the M1, M2, and the VIX index, perhaps you have more learning to do before you get into those, exercising your actual strategies. Keep everything extremely small. But different volatility regime. We have to handle it different. We have to prepare for it different. And we do have to dial back expectations a little bit on what is possible rate of return wise, because the same rule has always applied. There's no such thing as free money. Shorting volatility blindly, I get it. I know I've seen all the charts just like everybody else. Where's my... Oh, I don't have it. You can just imagine, I've shown this so many times. The long-term charts of VXX, UVXY, I get it. It just looks like a straight downhill. But the problem is, anytime you get a chart that looks like that, the few and far between spikes in the middle are disastrous for most people. So a lot of times people look at those charts that have decayed from 641 million in the case of the UVXY down to below 10. People just say, wow, could you imagine if you just shorted this thing? You'd be a millionaire. No, what actually would happen is you'd owe your bank millions of dollars. That's what would happen, because the whipsaw on the other side, it can go up 10 times faster than it can go down. So if you're a constant short vol type of person, well, just start the stopwatch on the end of your career, because you're done. I mean, the market will do something that makes that trade completely silly. So, that's it. We are clearly in a different volatility regime, and hopefully people have a plan for that. Hopefully people have, first and foremost, a risk management plan to be able to handle what's going on, because the whipsaws have been more violent and more often. So hopefully everybody stayed safe and continue to plan to do so. Like I said, just keep everything small, keep everything allocated, uncorrelated, and no undefined risk. You should be okay. So that's the presentation there. Give me a few seconds to glance here at the questions. I'm going to go through the first ones, the ones that I missed while I was doing my thing. Yep, I can see somebody said hit the like button. I know it's silly, but, there it is. YouTube makes me do it. So subscribe to the channel, smash the like button, right? Every YouTuber has to say that. If you made a video that you don't say smash the like button, did you even make a video? I don't know. So please do that for me. Hit the like button. It helps with the algorithm. UFC fan. I'm not a martial artist, but I'm a huge diehard UFC fan. Yes, I actually watched the first UFC. That's how long I've been watching this. We just accidentally stumbled upon it. My friend Dave, when I was growing up, we were in high school. His dad, his house, when you're growing up, you always had that one friend that their house had all the cool stuff. My friend Dave, his dad had, at the time, this is going to sound crazy for some of you young people, but at the time he had what's called satellite TV. He had one of those huge projection screens that was about four feet, deep, the TV. I mean, it probably weighed 1,000 pounds for the TV, but he had this giant TV in his house with satellite. And so we got the UFC. And my friend Dave, he was a martial artist. He was into, ninjutsu and jujitsu. And he actually did a couple UFC, not in the UFC, but mixed martial arts fights. And so we stumbled upon it, and I watched UFC 1. It was the most bizarre thing you'll ever see. Go back and watch those old ones, like UFC 1 to 5. Wild, Wild West. Pretty crazy stuff. So I was very lucky, and now I've been a fan all along. And we've got, 257 this weekend? We've got Usman and Burns. Yeah, I'm an absolute diehard fan. Hoping that Usman pulls it out. So we will see. But yeah, I will probably mention UFC several times. So probably good to know for you guys watching that, yep, I am a UFC fan. That's, if you follow me on Twitter, you might see a few references to it. All right. So any questions specific to what I presented, or do you just want to do general questions? Anything goes. I'm going to sit here and hang out with everybody for a little while. Hey, I know that island. You mean Vancouver? Did I miss something? Okay. Marty, I think a huge issue with macro investors right now is that the Fed is changing how the market functions. Interested how that would affect the Vixx. I think that there's some truth to that. There's no question that what the Fed is doing and the easy money and the Fed put, so to speak, there's no question that those types of things influence the market. The thing that I would always remind people, though, is that we always think that our generation, the time that we are in the market, this is the craziest thing we've ever seen, or this is the most manipulated market we've ever seen, or, fill in the gaps, whatever's happening now, the Fed manipulation, the interference with the central banks, hardest environment to ever invest in. We always have that recency bias where we think this is it. What I would tell you is that the longer that you invest for, you'll realize that there's always something there. There's always something in the market that's interfering. So yes, it's true that the Fed is doing things that it makes investing harder. We think that. Twitter makes investing harder. When you get a president who can ruin your day in one tweet, it makes things harder. But that's always the case. You always want to keep in mind that there's always going to be something in the future. So if it's not the Fed, it's going to be something else. If it's not President Trump, it's going to be President Biden. If it's not this, it's going to be that. I would suggest that people just trade the market that is in front of you, analyze it as effectively as you can, diversify as best you can, have strategies that can move in and out of safety, and it is what it is. The Fed's going to do what it's going to do. We still have to trade through it. But I agree. It certainly, like you said, from a macro investor perspective, it makes it very difficult. For me personally, I'm tracking volatility metrics, and volatility is actually fairly consistent from period to period. The raw numbers change, the absolute values change, but the relative differences between the metrics are surprisingly similar. So I feel like I have an advantage in that I'm basing my trade signals on metrics that, again, nominally those numbers might change, but relatively speaking, it's been very consistent for 20, 30 years. And I suspect it will continue. It's more the human condition of the volatility risk premium that is built into our brains, right? We always think future unknown events are going to be terrible, but they typically don't turn out to be that way. So Jesse says the island on my desktop. Sorry about that. I thought you meant the island that I'm literally on, Vancouver. I have no idea. This is just default. I'm not a screenshot type of or desktop person. I don't change it. This is just what my computer came with. Where is that? The island. You never told me where it was. What is the max allocation for volatility trades that you suggest? I can't. I can't, literally, legally, I can't tell you what to do. But also, I don't know what your strategy is. Not all volatility strategies are created equal. Some of them are going to be much safer inherently, and some of them are going to be so risky, you'd want to scale that down to 5% at most. If you're the type of person that actually is doing the unthinkable, which is selling call options naked on volatility ETPs, if you're one of those people, first of all, don't. But secondly, if you are, the reason you can't do that is because your allocation is going to get down to a level that is so small that even if you're making consistent profit from week to week, it's not going to impact your broad portfolio. If you're selling naked calls, I don't care if the individual strategy is making 50% a year. It doesn't matter. 50% a year on 5% of your net worth isn't even hardly worth getting. It's nothing. It doesn't impact your bottom line at all. So those people that you see on Twitter that are bragging about their big returns, you got to remember that that's based on a tiny allocation of their portfolio. Because if it's a big allocation, again, start the stopwatch on the end of their trading career, because that's what's going to end up happening. So my goal is to get the most amount of money allocated possible in the safest way possible. And if you do that, when you go on a good volatility run of shorting vol and protecting all the risk, and you make those big returns, it actually impacts your broad portfolio. So I can't tell you the numbers for me personally, 20% for my volatility strategies, another 20% for my hybrid strategy, which is equities, treasuries, and a short vol position. And then a good 40% to what I would consider just stocks, bonds, gold, equities. And then I have 20% to options trading, which is inversely correlated with my portfolio. So I would say 10 to 30 is sort of your generic speaking to 1,000 people type of answer. But certainly you'd want to break it down and be very specific to what you are doing. Because if you're risky, 5 to 10 max. And again, there's no point doing it because you're not going to impact your portfolio. If you have to reduce it down to such a small allocation, I don't care how much you make in your strategy of blindly selling. It just doesn't matter. It doesn't impact anything. So I would suggest be as safe as possible and then maybe increase your allocations a little bit. All right. Let me catch up here. Again, I've mentioned this before, but I don't see all the comments. So on your end, it probably looks a little bit different than mine. I had somebody email me recently saying, well, you skipped a couple of the really good questions. I don't see them all, apparently. When I watch the rebroadcast later on YouTube, I can see all the comments, and I think, oh, yeah, I missed a couple there. And I apologize. I just don't see everything that is posted, but try again. Maybe it's not specific to you. Maybe it's just a numbers thing. So if I miss it, 20 minutes later, ask the same thing. Maybe I'll catch it. What is the most efficient way to do a black swan hedge? Low cost decay relative to high reward for major market crashes and Vixx spikes. I mean, it's a good question, and it would be great if something like that existed, but unfortunately it doesn't exist, and the markets would cease to function correctly if it did exist. If there was a efficient way to hold long volatility, then everybody in the world would do it and the markets would break. I mean, that's just not how things work. There has to be two sides to things. And unfortunately, because consistency is on one side of it, right? Stocks going up consistently, short vol working out most of the time. That's the consistent side. It has to balance out the other way. You have to have shocking, staggering spikes on the other side. You can't just have slow bleed on the other side and slow bleed upwards on this side. It doesn't balance out that way. So unfortunately, the VXX, if you imagine what that chart looks like, that is completely normal in the context of what a rolling put option on the S&P 500 would look like as well. That is exactly what put options on the call options on the VIX index or buying VIX futures on the long side would look like. If you plotted it over time, it is literally the same thing as those diabolical volatility charts that we look at, that everybody says, well, look, that's broken. It's gone from millions to nothing. It's not broken at all. It's just that that's the volatility risk premium we have to pay, and it is expensive. So the question, the simple answer is there isn't one, which is why I don't hedge my portfolio. For me personally, what I do instead is I protect my position sizing, keep everything balanced and stable and uncorrelated, and then I allow myself to move in and out of positions based on market conditions. Hedging is just expensive, and it's almost always going to cost you more than the crisis that you're hedging against. Unfortunately, that's how it happens, that you will spend far more money bleeding if you're buying VXX, every week rolling positions, or VIX calls, just rolling positions. You'll probably bleed more money doing that over a several year period than you will actually lose when the eventual crisis does hit. Now, I'm not telling you to do that because psychologically it might be worth it to pay money to balance things out. But no, there's no way to do it. You can't save money. So the best ways to probably do it, if you're looking for real answers, is you're looking for high convexity hedges, like maybe long Uvxy with a very small allocation size. It can pay off if you get those big spikes. Out of the money call options on things like VXX, Uvxy, those can get that, non-linear payouts that maybe will hedge your portfolio a little better. But just know that you will probably lose money doing it. It's just for your own peace of mind, you will pay profits along the way in order to cut that drawdown at a certain level. It's not free. It will cost you more than it's worth. It's like insurance. You'll definitely pay more in your life in insurance than you got back from the insurance company. How many people are watching this right now? 100 people. Maybe one of you will have a insurance payout in your life that pays off all the premiums that we've all paid in home insurance, car insurance, all these things. It's insurance. You do it. So there is no efficient way. They're all the same. It's an efficient market. Everybody who trades VIX options, they also know how to trade S&P put options. Everybody who trades those, they know how to trade vol ETPs. They're all the same. It's exactly the same. Treat it as an efficient market. Assume that there's no arbitrage opportunities anywhere. It is what it is. You're going to pay for that. There it is. South Catalina Island. Really? Okay, cool. That makes sense. Mac OS system's called Catalina. Okay, I gotcha. Here's one. Do you have a video on how you approach your volatility trading? I like to short the pops, but I want to be more specific about it. Do I have a video? Well, conveniently, I have over 100 videos. I have hundreds and hundreds of articles. So, I hate doing that. I hate just saying, well, here you go. Here's 144 videos. Here's 600 articles. But yeah, the truth is I've been doing this for a very long time. I know it can be a little overwhelming at first, but pick and choose. Find the titles that jump out at you and find stuff. Unfortunately, there's no simple way I can condense it down for you in 5 minutes. There's thousands of hours of free education on there in articles and videos spanning 10 years. So I'm sorry. Good luck. Enjoy. Maybe I could narrow it down slightly. I could do better than that. Let me try again. Okay, so go on the website and go to dashboard. If you're looking for articles, start with those. Those 10, those 7, then do these. That's the first place you want to go. The second place you'd want to go is go to my YouTube channel and type in, say, VXX. And the ones that pop up, it's a little search bar button right here on the YouTube channel. These ones are the ones that you'd probably want to focus in on. These are much more specific to what you're looking for. You could do Uvxy, right? No, that's not how you spell it. Stuff like that, right? That's a good one. The other one, roll yield crushes it. This one's very specific for what I talked about today. So everybody can go watch this video if you're looking for something to do over the long weekend. Check out this one called Don't Buy VXX. Roll yield crushes it lower. Remember, roll yield, this is what I'm talking about here. It is essentially this metric called the VX30 to VIX roll yield. This video is all about explaining why that works and why the volatility ETPs look like a complete disaster on a long-term chart. So I would start with those if I was you. But again, apologies, it's overwhelming. I like to educate, and yeah, there's 10 years of stuff. I can't narrow it down. How do you use options to inverse a portfolio that's so diverse? To inverse a portfolio that's so diverse? I don't, do you mean like creating an inverse correlation with only a 20% allocation that inversely correlates the other 80? If that's your question, hopefully that I got that right. You can't do something in a small portion of your portfolio and have it cover everything on the other side. But the point is that what I do is I trade several different strategies that are in themselves, they have risk management built in. So my 20% tactical balanced, for example, it regularly rotates out of equities and goes into bonds and gold. So that in itself is already a diversified strategy. And then all of the strategies have safety positions as well. So when you combine it all together in a portfolio, it's not actually that common that we're in a very correlated positions. There's always something that's working, and there's typically something that isn't working. That's how diversification is. But yeah, it can't balance completely. Whenever you're trading, you have to risk something to make something. So there are times when I have all my strategies that are in aggressive positions, like right now, today. Gotta risk money to make money. You just have to make sure that it's done in a way that it won't rip your face off if you happen to get it wrong. Okay. Peter says, you spoke about correlation and that we should diversify our other positions than short volatility. So what do you think about that? Every asset class is either short vol or long vol. I think that's an accurate statement. I think that if you really want to dumb down the market, yeah, most things are short vol. Like buying the stock market is a short vol position. I mean, essentially, what's the difference? As far as correlations go, obviously there's a difference in that if the S&P 500 stays flat for a whole month and you're shorting volatility ETPs, that position can still make money, whereas the stock market, of course, makes nothing. So there are advantages to doing both at the same time. You know, some people might look at my portfolio and say, well, for example, this is a question that I got today. Go ahead and cover it. Why would you switch from the S&P 500 to a short vol position? They're both short vol positions, right? The long S&P 500 is definitely a short vol position in that it will profit if volatility remains low and stable. So why would you switch over to the SVXY? Well, the difference is that SVXY can make money even if the stock market goes nowhere, whereas the S&P 500 obviously needs stock prices to change. So they're not entirely correlated to each other, but clearly there is a correlation, especially on the ends, where if you get a big volatility spike, then yes, everything is long vol or short vol. Everything in the world is long vol or short vol. In the middle section, then you can start to get some separation between what's the difference between equities and stocks. In massive spikes, no difference at all. In mid-range markets, definitely a difference. What's the difference between short vol directly and option trading, say, straddles or something? On the extremes, nothing. They're both going to crush you in the event of a crash. In the middle range, huge differences. So that's what I would say to answer that is yes. If you really want to get down to it, probably 80 to 90% of all positions out there are essentially short vol positions. But I still do a wide variety of all of them because, like I said, there's a huge middle ground where you can play and work things off of each other and get those correlations working in your favor. Okay. Tracks relax. That's what I think. Just wanted to get my take. See, I don't see a question. That's a good example. I don't see a question from this Tracks Relax account. I see nothing. Sorry. It occurred several times. VIX went up along with SPX prior to a major market correction. Is that a consideration to watch out for volatility spikes when VIX moves in the same direction as the S&P 500? I would say no. I mean, you're correct in saying that there are times when that happened. When there's a positive correlation between the VIX and the S&P 500, you could get a situation where you might think that's a signal because it happened and then a week later the markets crashed or whatever it was. But trust me, there's plenty of times when that doesn't happen and the market crashes. And there's plenty of times that there's positive correlation and the market just keeps marching higher. So there could be some recency bias in that assumption. I can certainly run some numbers on it. I have in the past, so I can basically tell you without presenting a spreadsheet to you that it's very hit and miss, that type of indicator. But it does happen. Now, for an example, let's look at the average VIX index levels going back to 1990. So what this chart is showing, these are the annual VIX mean, right? So the average number for the year, every year going back to 1990. Now, a lot of these make sense. Of course, 2020, COVID, we're expecting a very high average VIX. It was 29.25, nearly a record, but not quite. 2008, clearly financial crisis, disaster. 2009, remember the financial crisis bottomed out in March 2009. So no question there was high vol there. 2010 had a flash crash. 2011 had the debt crisis. These are all explainable. My point is, what about these 3 years? What about 96, 97, 98, 99? 4 years there, even 2000 before the dot-com bubble finally burst. You're talking about 4 years where there was clearly a very high elevated VIX, not accompanying stock market crashes and terrible results. So you have to be careful drawing those correlations with things that could very well just be recency bias or coincidental correlations, where you certainly want to put in, you wouldn't want to put any real money on that assumption. Like if you see the SPY and the VIX going up at the same time, now all of a sudden you're going to be shorting the market. I wouldn't suggest anybody actually bet any real cash on that assumption, because it can be wrong just as often as it's right. Sorry, hopefully I got most of that, because again, I didn't see that Trax Relax comment beforehand, but I assume you're talking about the correlations there. How do you make good money yourself trading volatility? I don't know why myself matters. I share my entire portfolio for the whole world to see if they want. I mean, obviously there's a fee involved, but that's what my business is about. It's basically, I'm not doing anything that is designed to make money, right? I never intended to be here in this place where I'm managing something like this. I'm just sharing my own portfolio. So I make money for myself trading volatility. Where's that comment? Because it is a fantastic way to be able to actually quantify market movements. What I don't understand is how people intend to make money on things like technical analysis, whether you're looking at a picture, a chart, and you're actually thinking that that chart is going to give you clues. I just don't see it. I mean, I'm not going to go out on a limb and say it doesn't work, but boy, I just don't see how looking at pictures of charts could give us any meaningful information. Certainly none that would allow me to allocate my net worth to it. You know, macro investors, there was a previous question. I don't understand how someone could be a macro investor in this environment, but for me, volatility, and specifically focusing on well-protected ways to short volatility, is the most quantifiable, predictable way I know to make money. It's definitely not a sure thing. I mean, the hit ratio is probably 60-40. I mean, I have plenty of losing trades, and I have plenty of bad months and even bad stretches of my portfolio. But, you know, overall, things do tend to work out pretty well long term. So this is my leveraged portfolio. This one is actually a little bit riskier just because we do trade 2 times leveraged ETFs. This is the standard portfolio that I launched over 9 years ago now. It does have a way to work out. And a lot of this, I don't know if a lot, but a good chunk of this is short volatility profits. So I, for one, will always give people ample warnings and caveats and disclaimers. Don't do this if you don't know what you're doing. You can really end up losing more than it's worth. But yeah, short vol is a massive portion of my profits. Always has been. And I hope, always will be, because the volatility markets, while they will change, and the products that we trade might change, and the strategies that we employ might change, but the fundamental reason why all of these strategies, this umbrella of short vol, the fundamental reason why it works has been the same way since the dawn of time. There is a volatility risk premium there. It is. It's just, it manifests in different ways, and we have to find ways to capitalize on it. That's what short vol is. It's just weighing you don't want to be picking up pennies in front of the steamroller. What you want to do is pick up some pennies and then get out before the steamroller, and have methods to do that. But yeah, short vol is massive in my portfolio. Han says, subscription includes all my portfolio. If you want to see my portfolio, there is a subscription there. This is a public live stream, so I don't want these to sound like an advertisement. It's certainly not. But yeah, there is ways to get a closer look at what I'm doing. Succeeding using the wheel with VXX depends on harvesting premiums that exceed the decay of VXX. Are premiums presently higher in the new volatility regime, or are they about the same as before? Again, try to make the assumption that everything is efficient. So if you're looking for the answer to your question, yeah, premiums are higher. But what that also means is that movement is more, right? So that's how premiums are priced. That's how the options market is priced. If something is expected to move more, which we have seen for the last 3 years, things are moving more, things are violent, unexpected turns and whipsaws. So clearly traders need to be compensated for taking on that additional risk. So yes, premiums are going to be higher in that case. But if your question is a little bit more detailed one, that is the ratio of premium to expected price movement better now than it was in the past, I would say no, it's the same. Assume it's the same. Assume that the pricing of the options market is more or less getting it right. There might be inefficiencies, and you come up with examples. Oh, well, how do these big hedge funds and high frequency systems work? Sure. But for the general retail people like you and I, just make the assumption that it's all balanced for a reason and it's priced for a reason. So same now as before. It's just managing risk is a whole lot more difficult these days than it used to be, because risk comes faster and more violently. So that's why the volatility regime change that I talked about before matters so much. It's not that it's changing the dynamics. It's that it's changing how we approach the trading. Glenn asks, how will President's Day market close affect everything? Good reminder, the market's closed Monday. So if anybody's wondering, there won't be emails from me on Monday. But yes, how does it affect it? Well, the Vixx effect, if you're not following Russell Rhodes on Twitter, go ahead and follow him. And it just comes to mind because I watched a short video of his this morning, actually, talking about this. He was basically addressing what we can expect to see. And he had a cool chart. Again, it's Russell Rhodes. Let me just give you the exact. I like this guy a lot. He gives at Russell Rhodes, RussellRhoads, at Russell Rhodes. So essentially, the only difference that we can expect, first of all, the VIX futures, there's no real weekend effect for the VIX futures market because it's not a calendar problem, and there's a couple of reasons why there's what we call a VIX effect over the weekends. One of them is the fact that the VIX calculation is calendar days, but the trading days are, of course, only trading days. So there's a little bit of a zone there where market makers have to take out premium before the weekend. All of that stuff exists. But you can also not actually hold the VIX, which introduces another aspect of really why there is this weekend effect. On the other side of trades, market makers, dealers, and whatnot, it does cause a little bit more problems when you can't actually just hold and hedge directly on the underlying. So what we can expect over a long weekend is that the VIX will probably go up about 1%. It'll probably go up whatever it closes at today. Expect it to go up 50, 0.5% or 1% on Monday. And it won't be for, that's just assuming the market opens flat. There's no reason for it. It doesn't affect anything. And like I said, it won't affect the VXX or the VIX futures or options. All that premium is taken out ahead of time. Weekends don't do anything. Again, getting back to the old theme of everything is reasonably efficient. Market makers and dealers, they know what they're doing. They've taken out all that theta over the weekend, and it doesn't really matter. All it means is you get an extra day to relax and have a good long weekend. Don't expect anything fundamental to change with your trading. Question skipped. Okay, sorry. What about adding inflation-based rules to select the best performing ETFs? For instance, TIP instead of TLT right now. Yeah, the problem there is that you're getting into expectations rather than quantifiable metrics, and I don't do that in my trading. There's nothing that I don't like looking out in the future and saying, well, inflation is going to do this to the market and that's going to cause that, or the US dollar is going to change value somehow and that's going to do this. Those are all things that I would quantify, that I would put into the basket of when it happens, I'll deal with it then. But until it does, I don't see any reason. I mean, if you're saying you're preemptively going to move into different ETFs because you're expecting, inflation to do different things, or the dollar to do different things, or commodities, or whatever it is, I trade on 1-day timeframes. So I don't have to take into consideration any of those things. I need to be consistent long term, though. So I can't be bouncing around between, say, the TIP and TLT, and people often give all kinds of suggestions. Well, this one's doing better recently, and that one's doing better than this one. I know that they fluctuate over time, but I need to be consistent with what I'm doing, and I just hold the best historical positions at the time, and I'm not looking to truly optimize over short periods of time. So it takes a lot for me to make a change like that. And again, when it happens, I'll deal with it then, but it's not going to happen tomorrow, so it doesn't matter to me. I'm going to be willing to take brand new positions on Tuesday when the market's open if necessary. Don't need to worry about 2022 or whatever it is. What is a 2x leveraged volatility product? You missed Vixx. Yeah, well, you can always simulate anything you want with the Vxx. So you can go through a quick example here. If you were looking at the Vxx, right, and you wanted to simulate the Vixx, which is a 2x volatility ETP, what you could do, you can see I have a position open in June on the Vxx, and my position is right here. I'm holding $20 put options in the money on the Vxx. You can see the delta is 0.47 here. So if you wanted, you could either do one of two things. In a normal stock, if you could get a very high delta, then you could do that and you could double your shares. And that would be taking a 2x position. Unfortunately, with vol ETPs, just the way that the skew all happens and stuff, it's very difficult to do that. So you'd have to do it with different contract size. So for example, find the 50 delta. This is the 22 put option. You could buy this put option for $9. Actually, what I need it to be is smaller than 16. So where's the $8? This one. This $20, 21 strike right here, you could do that position. And what this looks like is this is essentially a short volatility position. The VXX is here, and you can participate day to day. Don't worry about the turquoise line. We're talking about the pink line here, daily profit curve. You can participate at a 0.5 leverage factor to the VXX as it's going this way. So all you really have to do if you're trying to simulate more volatility, like a TVIX or a UVXY, you increase your delta, and then you increase your share count, your number of contracts that you purchase. So if I were to do that position at the 21 strike with a 50 delta or whatever it is, I do everything risk or cash secured. So I would take the VXX price right now, let's say $1,600 is the baseline. I would buy one option contract per $1,600 that I have available capital. If you wanted to increase that, and I'm not suggesting that you do, just answering the question, you could buy higher delta, so you could go down more and increase the share size. So instead of doing what I did, which is cash secured 1-to-1, you could end up allocating the remaining money to the position as well. And you can actually turn the VXX, and certainly on the UVXY, you can do it even easier. You can simulate different leverage factors. So typically I like to simulate 0.6, 0.7. That is an inverse, sort of like the SVXY right now is a 0.5 leverage factor. The old XIV was 1. I like to simulate sort of in that middle range. So we typically 0.6, 0.7, but you can also go the other way. You could simulate even more. You could easily simulate TVIX. Just higher delta, more contracts, use up that available space that I don't use. I just keep it as cash on the side, use up that. Now all of a sudden you're going to have a highly leveraged product again. Options are a good way to do it as well because depending on where it lands, sometimes the option contracts, even if you're exposing more, you can still, the payout is less than buying the shares outright, which means if you did get hit with just a 1-day brutal spike, with options, you can only lose the money you put in. And so it might actually add some protection there. Plus, of course, long options have positive vega. So if you get a massive volatility spike, you're essentially simulating short TVIX with a built-in margin factor there, a little kicker that your vega is positive as well. So you might actually end up not losing as much as the broad market. Of course, the flip side is that you have more theta decay, but that's why we go further out. Essentially, that's what you would do. You would just crunch your numbers. Delta, contract size, pretty easy stuff. Once you do it once or twice, it's pretty easy. Where's that question? What about the hedge? What Bill Ackman did in the pandemic? I think he did CDS with 100 times return. Why is that possible for hedge funds? Nothing similar for us common folk? Well, if what you're referring to is that time that he took a position and then went on national television and used his name and his brand to tell people to do things that made him $2 billion, yeah, that's not available to us common people. I can't go on Bloomberg and CNBC and tell everybody the positions that they should be in. I can't do that. So, but I think you'd be mistaken if you said that it's not available for us common folk. What you could do is you could start a subscription service and you could front run your community. And if you build a community with enough size, you just send out tweets to your followers saying, I'm going to buy this position, get 500 people to join the same position, and you can make a great return. Now, of course, your followers won't make any money, but you, the subscription person, you can be front running your community and you can be Bill Ackman and essentially doing the same thing. But I'm being a little bit tongue-in-cheek. No, it's not available for regular folks. Certainly not available if you want to do things correctly and take care of other people and investors and be fair and free in the market. So definitely not possible for you and I. What brokerage do you use and where do you stream your data from? I'm Canadian. Believe you are too. What I just showed you is Thinkorswim. Now, this isn't my main account. This is my, I just opened this recently for the live streams. I just wanted to have something to show people that looks really nice. Of course, Thinkorswim is a really, really nice looking platform. And it's robust. You can do all your calculations here. But the main one that I use for my long-term portfolio is Interactive Brokers. So if you're looking for just the big ones, right? Thinkorswim is really good. Interactive Brokers is good. I've been using Interactive Brokers for a long time. I don't like it on video because the platform is just the ugliest thing in the world, and their charting software is just the worst ever. But as far as actually executing my trades in my portfolio, that's the one that I use. They have better statements. They've got lower commissions, or at least they used to. Commissions these days are pretty close to zero. But the second part of this question, unfortunately, is I'm Canadian citizen, but I'm not a Canadian resident. So I have international accounts, and that might be a problem if you're a Canadian. So I don't know what's available for you specifically, but for me personally, I'm probably not in the same situation you are. As many of you who are watching my stream know, I am what is called a digital nomad, where I don't really have a home. I travel around a lot, and I'm not a Canadian resident. So I'm able to have international accounts at Thinkorswim and Interactive Brokers. And if I wanted Tastyworks, that's another one. I don't think Canadians can open up Tastyworks. So you might just have to do the best you can. Just find whatever low commission, large broker that you can do, and I'm sure they're going to be fine. It might not look as nice as the one I showed you. Thinkorswim is great in that respect. But they all kind of function the same these days. I shouldn't highlight that. Thank you very much for the compliments. No, I'm doing the best I can. I'm trying to help people. And what I do and what I share, it doesn't affect what I do, right? So it's not like, I mean, I've always been trading my portfolio, and I always will be in this way. So whether I share it with people or don't share it with people doesn't affect anything I do. So I like to educate as many people as I can. I like to do hundreds of articles and videos. I mean, why not, right? I only spend probably 30 minutes maximum, probably about 15 to 30 minutes a day actually doing trades. So, what else am I going to do? I like sharing my work and explaining things in detail. I'm not somebody that you will see spending much time on things like Twitter or, Facebook groups. When I explain a concept, I need a video. I need a 1,000-word article. I need to actually explain it. So unfortunately, that means there's quite a barrier to entry with my work. There's a lot of what I would call lowbrow type volatility stuff that does very well on Twitter and gets people a lot of followers, but you won't learn anything from that. Unfortunately, you have to just roll up your sleeves and do the actual work. Read long form articles, read books, watch hour-long videos and live streams. Can't learn from 280 characters on Twitter. It's meaningless. You might as well, if you're trying to learn how to trade, delete the Twitter platform. That would be my recommendation. Where's this at? Disnat. I assume this is a follow-up question to that. I'm not familiar with what that is. Which I'm not saying it's bad, but that might be a red flag. I would suggest people just stick with the big ones. Since all of them have gone low commission these days, I'd just go for the biggest name that you can find in the country that you're in and go with those. Well, I'm going to disagree with that. I think you're referring to Interactive Brokers. It is, come on. You think Interactive Brokers looks like this? Look at this. I don't know. I mean, of course, this is personal. It's going to be what people's... Oh, wow. VXX down a lot. Let's do a side tangent here. That trade that we had open is profitable by 3 cents now. And this one's way up. So that's pretty good. All right. So next week will be interesting. Sorry. But yeah, what am I doing? That's not the one. Thinkorswim is the nicest looking. Interactive Brokers is, that's the one that I use personally. So of course it's not a recommendation, but I would say that it would serve anybody's needs. I'd start with those two. How long have we been going? Hour and 12. Okay. I mentioned Tastyworks. What do you think about Tasty Trade approach? For that question, you're putting me in a position I don't like to say negative things about anybody. How am I going to do this diplomatically? So Tasty Trade, their approach to trading, I wouldn't pay too much attention to their approach. What I would look for on the Tasty Trade sort of platform, all the videos they do, all the shows that they do, it's about basic education. You can really get a good baseline for what's going on by listening to those shows. They're really good at that. I would recommend getting your baseline education from Tasty Trade. You're not going to be paying some guru for their services. You're not going to be buying some expensive course. I mean, the reason that I don't sell some expensive course is I just don't agree with that ethically. I think that you should be willing to give at least 90% of what you do completely for free. All right. I do charge money for my service, but there's no way anybody could look at my service and not say that, well, he did actually share tens of thousands of hours for free as well. So I really think you want to look for things where they are sharing 90% of it for free. Up front, they'll just give it to you. And on the tail end, they might charge you something for it. So that's what Tasty Trade is really good for, is that you can bypass all of those people that started their trading career and their trading business, their service, at the same time that they started social media. Remember, the business is their learning process. A lot of those people that have courses, expensive courses, subscription services, they're learning on the job. They are just doing what is necessary to get eyeballs on the picture. What Tastyworks is doing, or Tasty Trade, is, I mean, these are people, they don't need your $50. They're giving a lot of information for free, right? Obviously, Tom Sosnoff is a mega millionaire from Thinkorswim. You can learn a lot from people like that. And there is a genuine desire to teach. is what I'm essentially getting at. So for that, absolutely. And then get your baseline, get your education. It's entertaining as well. Those guys are funny. I mean, way more entertaining than I am. But when you want to get to a higher level of actually allocating a portfolio and building strategies, for that, I think that it starts to fall off a little bit is what I would say. I don't want to, cast aspersions on anybody, but yeah, I think they're great for getting that baseline information and remaining true to what I've always believed, that the only people you should be following are people that are giving nearly everything away for free. Those are the only people worth following. If you're following somebody who only has a website because they want to sell you something, that's a problem. If you're following somebody who didn't have any articles published, no videos published until the day they launched their business, red flag. Stop following those people. You can see my work going back 5 years before I made my first dollar in this business. I joined Twitter 7 years after I, launched my business. That's who you want to follow, and Tasty Trade is really good for that. So I would highly endorse what they're doing up to a level, and then you want to look for more, the more nuanced volatility stuff you're not going to find there. I don't know. I haven't heard. A lot of these brokers I won't know because it's country specific, and I really don't know. Oh, late to the party. Thanks for dropping in, Tom. Or maybe that means you're leaving. Maybe that means you watched it all and you're leaving. If that's true, thanks for watching. Good afternoon. Have a great weekend. Otherwise, there will be a rebroadcast. Have you considered, or would you consider, disclosing, why can't I see the bottom of this? Disclosing the current year monthly results of your VTS strategies. You mean January 2021? I typically do the results about 2 weeks after the month, so around, say, the 10th to the 14th. The only reason I do that, I know my results right on the first day. Like February 1st, I knew what the month was. The only reason I do that is I don't like to update my spreadsheets twice. And hedge funds and certain funds out there, it takes a couple of weeks for them to publish their results. So I typically wait till about the 12th or something, and then I just do it one time. I update everything, update the hedge fund indexes, the SIBO Eureka Hedge Volatility Index, all on the same day, and then I put it on the website. But yeah, it'll be up there. I've shared my results every month, every day for the last 9 years. It'll be up there. It's not going to be good, but it's going to be up there. I mentioned this last time that as a former professional golfer, there were many times where you just wanted to go straight from the 18th green, walk straight past the media tent, just go straight to the car and get out of there. You don't want to see anybody. You don't want to speak to anybody. One thing that I learned is, and I was fortunate that people were wanting to interview me, right? There were a lot of people maybe didn't get interviews. So I was fortunate in that sense. But you have to own up to everything. So I've learned that, and I've been doing this for 9 years. There's been plenty of months where I've shown some numbers that are not great. And January 2021 won't be pretty. I think I haven't done the numbers yet, but down 4.9%, I believe, for the month in the total portfolio, and down about 5.5 something in the leveraged portfolio. So doing better now since in the last couple of weeks, but yep, it'll be up there. It'll be ugly, and it'll be there probably, since it's a long weekend, definitely by Monday. So expect that. When do they make a reverse split on Uvxy? Sorry, I'm going to try to open another spreadsheet. It takes about 30 seconds. My spreadsheets are kind of messed up. But we can go through just a very quick example of when we can expect. And again, this is only going to be based on sort of long-term numbers. That's the best we can do. We can't ever nail down anything because some years it decays far faster than other years. But once my spreadsheet here loads up, we can actually go through a live example of what we might be able to expect. So let me do a screen share here. Hopefully you can see this. Uvxy is at 943. Okay. Uvxy is at 943. Uvxy long-term decay factor, this is all here. I did a video on these all in the past, just last week actually, so you can check out that video. But the Uvxy decays 2.1% a week. So the decay calculator here, if we start at 943, which is the Uvxy right now, as we are sitting here today, and the Uvxy one-day decay factor is minus 4.23, so it's going to be that one. Right here is what we can expect based on long-term averages. Of course, this is going to be Uvxy, and that number is going to be different. I don't want to change it live here, but this is the decay factor we can expect. Now, the Uvxy, of course, as we know, when it gets to reasonably low numbers, it starts to consider doing the reverse split. So if we go to the reverse split data, sorry, that's why these spreadsheets take so long to load. You can see these are all the reverse splits for Uvxy. I'm expecting probably a 1 to 5, and let's just ballpark it. I mean, there's no set number, but let's just ballpark it. They will reverse split when the Uvxy hits, I don't know, pick a number, 850. Let's say 850, $8, 850. Let's say $8 because it's an even number. So right there, 38 trading days from now, we can reasonably expect that if the decay factor maintains itself, 38 trading days from now, when it hits $8, it will do a reverse split. So there's 21 trading days in a month. 38 from now is going to be about a week shy of May 1st. So we're looking at last week in April, if I ran those numbers correctly, basically just shy of 2 months from now. So, April 20th, based on actual decay factors, right? And this is not guessing. This is mathematical. Uvxy since 2004 has decayed 2.1% a week. This is just the long-term mathematical, the fact of how much it decays. This isn't somebody just guessing. And so, yeah, I can expect that if they do a reverse split when Uvxy hits 8, which, again, we don't know for sure. Maybe it's 7, maybe it's 9. And if the long-term decay factor maintains itself, then, yeah, mid-April, I would look for a Uvxy reverse split. Hopefully that answered your question. I get this a lot. I mean, every stream. What I do is similar to Christopher Cole. I would say that we have overlap, a lot of overlap in what we talk about. The difference is pretty stark, though, in that his portfolios are essentially buy and hold portfolios. He's just structured them in a way that he is holding long volatility, commodities, international stuff, precious metals, all those things. That is not me at all. I'm an absolute tactical investor, very short-term, in and out, moving to safety at the first sign of trouble. I don't design buy and hold portfolios. So our philosophy of the markets in general and how we view volatility and the role that volatility, especially long volatility, plays in a portfolio, I would say there's a lot of overlap there. And I like him, personally. I don't know him, but I like him and I follow him. And yeah, knowledgeable, good guy. But there's major differences how we actually structure our trades. So, it's not a competition, but I have my doubts as to whether those types of portfolios can perform well and keep up, because there's a lot of bleed there. There's a lot of, in my opinion, unnecessary holding of positions that are not advantageous in the moment. I would prefer to just, today, I want to make sure that going into Tuesday, right? It's a long weekend. Going into Tuesday, I'm holding the best positions for that day. And that's it. I don't care about next year. I want to make sure that next Tuesday, I'm in the best positions. And I'll adjust for Wednesday on Tuesday. I'll adjust for Thursday on Wednesday. That's what I do. So similar, but also structurally quite different. Okay, so just to give you an example of how difficult this live stream actually is. What happened? The last question, I was down to one more question. I looked at the time and there was one more question. I was going to answer that and then leave. The stream has jumped And there are now, this is the last question I see. There's at least 30 since then. And it hit me all in the same second. The stream just absolutely jumped on me. So no chance I can get to all of those. It's been an hour and a half. I'll watch on the rebroadcast. I'll be able to see all of those questions that I don't have time to get into that. And we'll just schedule another one. So my goal is more of them and then keep them shorter. So one thing that I want to do for next week, let me just show you the VIX futures here. The next stream that I have planned, if you look at the VIX futures term structure here, some of you might know this. This one's expiring soon, right? 4 days. It expires next Tuesday, Wednesday morning, basically, with the weird settlement of VIX. But what I want to do is a live stream probably on Tuesday, and I want to actually break down the volatility curve here, the VIX futures term structure. And so I will do that for about 20 minutes. And then, of course, we will get into everybody's questions as well. So that seems to be a good time to cut it off. Hour and a half. This is my shortest stream I've ever done. I like it. So I can go running, and I will plan a stream for everybody on Tuesday. Come back with the same questions, and I promise you I will always give priority to what is asked up at the top section. So hopefully you enjoyed the little volatility regime change data dump there. I like charts and actual numbers. I don't like to guess on anything. So hopefully you guys are as geeky math specific people that I am. So thanks for joining. If you could give it a thumbs up on your way out the door, that would be very, very helpful. But have a great long weekend, everyone, and see you Tuesday. We'll do another live stream. Thanks.